financial literacy, and the human condition. Welcome to Financial Fitness with the Money Doctor, Dr. Francis Rayam.
Hi, it's Francis. I just wanted to take a minute to thank you for watching this video. If you're catching us on YouTube, please help us help others by clicking like, subscribe, and all notifications so you don't miss any videos. And check back for the next video. I think you're going to love it. Thanks again. For more information, you can visit us at hugyourmoney.com.
Welcome to Financial Fitness. I'm Jess Tyler, along with the Money Doctor, Dr. Francis Rayam. Hi.
Hi, Jess. Welcome back. How are you?
I know I've been taking kind of a day off here or there, but I noticed that every time I take a day off, by the way, I blow a ton of money. So
Oh,
I probably need financial advice next time before I take the day off.
no, I don't think there's anything wrong with taking a day off and spending some money as long as you can afford it. Yeah,
Yeah,
absolutely.
right.
Yeah, I notice when I take a day off, I pay for it when I come back, and that's the story of
Hmm.
self-employed people, but still it has to be done every now and then. Today I wanted to talk about a way to leverage your money that people, it's not really the first thing you think of when you think of,
Hmm.
"Hey, how can I leverage my money?" That usually points to some sort of risk, right? Risk and leverage. I'm going to buy real estate and I'm going to trade one property up for the next, and I'm going to keep doing it. And so people will say, well, you're highly leveraged, and they assimilate that as a risk. But in fact, this is quite, it's an incredibly safe way to do it. And I'm
Okay.
not talking about it specifically as an investment, but I led off with that because I want people to hear that message, that this is a way for you to leverage your money. This is a way for you to create generational wealth for
Okay.
not
By leverage your money, what do you mean by leverage your money?
turn $1 into $1,000.
Oh, like that.
Like that, okay?
Yeah.
But here's the kicker. You're not gonna feel it probably. In some cases, you will be the one who reaps the rewards, but in other cases, it will be the next generation,
Hmm.
okay?
Okay.
So I'm talking about a way to create generational wealth, when you think you can't afford it maybe, or
Hmm.
to protect your assets when you're well off and think, "Well, I'm just gonna leave all my money to my kids. Who cares? They'll spend it. I don't care." You should be thinking about a way to protect your assets and leverage that and grow that into a much larger pot of money for not much money.
Okay. That sounds
Uh,
good.
Doesn't it? All right. Now,
Yeah.
here's where you hear the needle scratch across the record like, it's life insurance. It's
Life
life
insurance. Okay.
insurance. Okay. Now, I don't talk about life insurance very often because even though I'm licensed to sell life insurance and we write some policies every now and then for people that want them or need them, clients, but I've not been a person who's been beating the drum about you need to buy life insurance from me
Hmm.
because I'm not selling you life insurance. What I'm talking about is a way for you to make your finances better for you and your family. Okay. So the first thing you think about when you think about life insurance is what? Dying.
Dying.
Yeah,
Yeah.
dying. I mean, who wants to talk about this, right? We're all going to do it. None
Right.
of us want to, and we're not in control of it usually. Okay.
Hmm.
So when you're talking about something that has an emotional barrier to getting over a hurdle, this is one of them. Long-term care insurance is another. No one wants to think about being in a facility for the rest of their life. But the reality is, many people will. A bigger reality is we're all going to die. Every one of us, no matter what we think, we will end our trek here on life by dying. The question,
Right.
what are you going to do about that? What pieces can you control of that? And without getting into the whole emotional part of it, one of the things you can control is what happens after you're gone for your family, your charities, your partner in business, whatever, your cat,
Hmm.
your dog, you can control some of this. And the
Yeah.
way you do it well is through certain kinds of life insurance. Now, we can go through a lot of details about what kinds of life insurance there are and how you decide how much you're going to need and
Hmm.
what you do with it. But at the core, what I want people to realize is that life insurance is a cheap way to generate more money. Okay.
Okay.
You might be generating it for yourself in the future as a stream of income, which could be tax-free, in fact.
Hmm.
Might be generating it to leave behind to someone else. But
Okay.
no. So many people ask me about this. They ask me about, well, I need a trust because I have this kid that, I have two kids. One kid is really great with money, and the other child is, they're going to blow everything in a heartbeat.
Right. Yeah.
So
And you
I
hear about that all the time.
yeah, so I really want protection. I want to have a trust. Well,
Hmm.
maybe they have so much money that they need a trust to get around some tax issues, and maybe
Okay.
they don't. If they don't, well, even if they do, I guess, but if they don't, the expense of managing a trust and the layers of putting a trust in place may or may not be in their best interest, and that's a
Hmm.
question for an attorney. But one thing they could do through life insurance is they can, I hate to say this phrase, but in some way they can sort of moderately control their money from the grave, a thing that
Okay.
we cannot do, right? We're always told you can't do it. Once you're gone, they're going to do whatever they want.
Right. Yeah.
Well, okay, so here's one little tidbit. You could have something on your life insurance called a restrictive beneficiary form.
Okay.
And that says how the person will receive the money. Now there are limitations on it. Usually it's over a 5-year period or whatever. But instead of leaving your child, $1 million instantly that they're going to buy a Lamborghini with or whatever, you could
Hmm.
say, no, they're going to get it as a stream of income over 5 years. And the life insurance company, I always tell you these little known facts, right? When have you ever heard about restrictive beneficiary forms, right? But the life insurance company will administer that because it's in your.
Okay.
So one of the things you need to know about life insurance uh, is that the death benefit is almost always a guaranteed thing. Now there are variable life policies and universal life policies and variable universal life
Yeah, it gets confusing.
policies and term policies, and we could go on and on about the different kinds of policies there are. There are almost as many policies as you can think of,
Hmm.
but for most of them, the core principle is death benefit. So when you're buying a life insurance policy, you're saying, here's X number of dollars. Uh, I want to buy this death benefit. Now, there will be, probably a physical or some medical records, that have been gotten from the MIB, the Medical Information Bureau, or, or you may or may not qualify for that, or you may just be rated. So sometimes a lot of people will say, well, I'm diabetic. I don't know if I can get life insurance. Yes, you can probably get life insurance depending on the underwriter, right? Which company
Hmm.
is offering it based on your health. And so they might charge you a little more for your
Right.
premium. Premium is what you pay for it monthly or annually, right? They might charge you a little bit more for your premium to offset their risk because of your health. But that
Okay.
doesn't
That makes
mean you
sense.
can't get it, right? There are
Yeah.
even situations where you are, quote, uninsurable and you can still get a guaranteed issue policy, which we can talk about. Okay.
Okay.
So that core principle is providing a death benefit. Now, what
Hmm.
that death benefit does is where it gets tricky. Okay. Uh, for instance, in term insurance, now let's talk about why it's so confusing for people when we say, oh, it's term insurance. And they say, oh, no, I think I have cash value in that. You don't. If it's term
Okay.
insurance, you don't have cash value in it. Term is called term because it only lasts for a specific term of time.
Hmm.
So you might have a 10-year term policy or a 20-year term policy or a 30-year term policy. But at the end of that term, something major happens to that insurance. It could be that it just goes away completely,
Hmm.
or it could be that it is what we call guaranteed convertible. Again, these terms are tough, but
Is
guaranteed,
that guaranteed convertible to whole life insurance?
yeah, to some form of life insurance that might be more
Okay.
permanent. Okay. So at the big umbrella, we have term and whole life, right?
Hmm.
Term is the stuff that you don't pay very much money for, but it disappears at the end of the term. Whole
Right.
life is somehow more expensive, but is more permanent. Now, under both of those umbrellas, there are, a multitude of layers. For instance, under
Right.
whole life, that universal life, variable life, all those things, they're all some form of whole life policy, which is a term for, I hate to use the term, it's a name for a permanent policy. Okay.
Okay.
So permanent versus temporary. T for term, T for temporary, P for
Okay.
permanent. Okay.
Oh,
So
that's a good way to remember it. Yeah.
T for temporary. Okay. There's nothing wrong with either of these kinds of policies if they're the right one for you. If they're not the right kind for you, then you're going to be sorry that you bought them at some point in the future. here's an example. You buy a term policy and you say, this is great because by the time this term runs out, my kids will be grown. And the kids are grown, but you've layered on a pile of debt, and your wife or husband has stopped working and doesn't have any income, and you now have no life insurance. You're going to be
Mhm.
sorry that you didn't buy something more permanent to cover
Right.
those. Or the other way around, you bought something permanent, you threw a ton of money into it. You said, I'm going to do this as some major retirement vehicle and I'm going to save money in here tax free. And it turns out that you never needed it at all. You ended up with no debt, you prepaid your funeral expenses, you don't have children to leave it to, whatever. And you've sort of overpaid for that unless you choose to leave that money to a charity, for instance. Okay.
Mhm.
So I'm bouncing around a little bit here, but I want people to just recognize uh, I'm going to talk about the power of banding briefly before we go to break.
Okay.
So the power of banding, when you're talking about life insurance, whether it's term or whole life, any kind of life insurance, companies give you a discount for banding. It's like wrapping your bills in $1,000 bills or $2,000 piles or $5,000
Mhm.
piles, right? When you take them to the bank, it's a lot
Yeah.
faster to turn them in than if they have to start counting out your pennies. Okay. So insurance companies band life insurance. So if you buy $0 to $25,000, it might be X number. It might be, let's say, a dollar a thousand, just to use a figure, right? And then if
Okay.
you buy from 26,000 to 35,000, it might be 88 cents a thousand, right? So the more
Mhm.
you buy, the cheaper it
The cheaper
gets.
it's gonna be. Yeah.
In fact, here's one little known thing that I'll tell you. If somebody, let's say a life insurance agent comes to you and says, so Jess, how much can you afford monthly? What do you want to spend monthly? Oh,
Mhm.
I could go on for an hour about why that's the wrong question, but
That's what car dealers do too, by the way.
yeah, yeah. So when they say to you, what can you afford monthly? And you say $50, and they say that buys a $100,482.58 policy,
Mhm.
your answer should be either, I don't want to do it that way, or at the very least, I only want 100,000. Because for that odd number, you're paying a different amount, right?
Okay.
Because of the banding. Okay. So if you know about banding, then you know that a $25,000 policy might cost you $50 a month, but a $250,000 policy will not cost you $500 a month,
Mhm.
even though it's 10 times as much.
So you
Okay.
might be able to find that sweet spot where you're getting the rate that you want, but you're getting a little bit more.
You bet. And so we'll talk in the second half about how to decide how much money you need in life insurance and whether you need it or not. But just so that you have some idea at the beginning here of what you might be able to use to create generational wealth for your loved ones or your charity on a tax-free basis.
I wanna get your phone number first,
Sure, it's 413-773-3333.
or you can go to hugyourmoney.com. We'll be right back with part 2 of Financial Fitness with the Money Doctor, Dr. Francis Ram on WHMP.
Financial Fitness with the Money Doctor is sponsored by Hug Your Money. So unique, it's patented. Financial coaching and more information at hugyourmoney.com.
Welcome back to Financial Fitness. I'm Jess Tyler, along with the Money Doctor, Dr. Francis Ram. Hi.
Hi, Jess. You stuck with me through the whole dying thing and everything?
I did. Well, we're talking leveraging money, not life insurance. So I like that.
Yeah. So, a lot of salespeople will try and spin it for you and say, this is really your investment vehicle. Let me
Mhm.
start by saying it could be an investment vehicle. And for anybody who's really interested in that or wants me to take a look at what they've got already and give them an opinion as to what I think it is, I'm happy to do that. But in my experience, it usually takes a lot of money to make it a good investment vehicle, or you need to be very young.
Okay.
Um, so when I see people who say, well, I'm putting $5,000 a year into my life insurance because it's my retirement fund, I wince a little and want to look at the policy. When they say I'm putting, $200,000 a year into it, they might be funding that heavily enough, if they have the time to make it work, to end up building an enormous tax-free pot of money that they can take
Mhm.
out or they can leave to their heirs or whatever. But you just have to be careful that it's not a sales pitch, that you're looking at the math and you really see it in paper, on paper.
You just said something about either your one of two things, which one was extremely young. What is the best time to start thinking about buying life insurance? I think probably most people in their 20s and 30s don't think about it at all. Or
Yeah.
maybe they do. But when is a good time? When should you start thinking about it?
The earlier you think of it, the better.
Mhm.
In the old days when we used to walk uphill and back, both ways
In
to
the
school
snow.
uphill, right?
Yeah.
Like in the old days, people used to buy policies for their children, and some still do. And that can be an incredible gift. You pay almost nothing for it. And you
Mhm.
put, let's say 5, 10, $20,000 on a kid's life. And, it gets paid off, like it's probably a permanent insurance policy, not term. And it gets paid off in full and it just sits there and builds cash value. And maybe the child doesn't even know about it. And someday in the future, they're getting married or they're buying a car or they're looking for a down payment on a house. And lo and behold, there's a few $1,000s in there, sometimes
Mhm.
much more than that. In some cases, I've seen it where the cash value exceeds the death benefit. And I have to say to people, wait, wait, wait. If you die, they're going to pay the death benefit, not the death benefit plus the cash value.
Mhm.
So you want to take this cash value out now. And, so while we're on that topic, let's talk about how you get the money out of life insurance because you can cause yourself a real headache when you do this wrong.
Okay.
Okay. So I'm talking about the money being tax-free inside, say, a permanent type of life insurance, right? One that builds cash value. So you have your
Mhm.
death benefit, let's say $100,000. Maybe you have cash value of $25,000 in there and you want to take
Okay.
some money out. Okay. If you withdraw the money and cancel the insurance, if you let the insurance lapse,
Mhm.
you no longer have a death benefit and the money you took out becomes a taxable event.
Oh, you don't want that to happen.
You really don't want to do it that way if you can help it. What you
Mhm.
want to do instead is to borrow the money out of your life insurance, at least pay the interest back every year so that the loan
Okay.
just stays level, right? So
Mhm.
you get an interest bill, you're paying yourself back, right? You're paying the interest on it, but you're keeping that loan level because if let's use that scenario, you have $100,000 policy, you have a
Mhm.
$25,000 cash value in it. Let's say you decide to take out 20 grand. You take 20 grand out and you die tomorrow, they're going to pay the $100,000 less the 20,000 that you took out, right?
Okay, so you're down
But
to 80.
you've borrowed. What you're doing is borrowing your own death benefit.
Mhm.
It's that simple. You've got death benefit. They say this is how much of it you can borrow. You're borrowing your own death benefit. But
Okay.
the law says you never have to pay it back. So that word borrow is a little deceiving. You don't
Mhm.
have to pay it back, but it will accrue interest. And if you don't at least keep the interest at bay, that loan will grow until such a time that it eats up all of the cash value.
Right. Yeah.
And either you have to continue to pay a premium that goes up or you will have your policy lapse, thereby creating this taxable event for the money you took out. So the smartest way to do it is to keep paying your premiums,
Mhm.
borrow the money out, and at least pay the interest on it every year so that you just borrowed some of your own death benefit. Simple, easy peasy.
Is it like a 401k though, where you have to have a specific life events in order to borrow, or can you borrow for any reason you want?
Great question. Yeah, it's yours. It's your death benefit. You're borrowing
Okay.
anytime you want for as much as you want up to the level they'll let you borrow. And it continues to grow. So the way that permanent insurance grows cash value, it's different from policy to policy, but in general, what happens is the amount of death benefit that you buy
Mhm.
then it doesn't always have to, but it can generate cash value within that contract. So think of
Okay.
it like interest on your savings account. The more money you put into savings, the more interest you make
Right.
that's available to you, right? Now, in a plain vanilla whole life policy, so not to get into the weeds on these sort of uh, mongrel kinds of policies, which actually turn out to be a lot better usually than a plain vanilla whole life policy.
Sorry, I just had a sneeze.
Bless
Okay, I'll cut
you.
that out.
Bless you. That's okay. Um, so rather than talk about those kinds of policies, let's talk about a plain vanilla whole life policy, which I almost never see anymore and definitely don't approve of as a first run thing because it's the most expensive
Okay.
form of whole life you can buy, right? Most expensive form of permanent life. But to make it very simple, that policy generates a dividend, like a stock would generate a dividend, right? Only it's not
Okay.
a
Yeah.
life insurance policy. So it generates a dividend, and there are several options that you can choose for that dividend. One of them is you can have it build up cash value. Another is
Mhm.
that you can have it by little bits of paid up insurance. So your $100,000 policy generates a $10 dividend, which buys $100 worth of coverage, and now you have $100,100 of coverage, and it
And that
continues
adds up.
over and over again. And that, in fact, can generate more cash value, interestingly
Mhm.
enough. Another thing you can do that people don't talk about, and often we use this when people come to me and they say, we're trying to cut corners and we're paying $200 a month for this life insurance, and we're thinking of canceling it. And I say, oh my gosh, you have a $250,000 policy here. You're going to cancel it for $200 a month. Do you know how many $200 a month payments you have to make to break even on your $200,000 policy? No, don't cancel it. Do this instead. And
Right.
what this is we might change a dividend option on it to pay the premium. So if the
Okay.
policy is generating enough in dividends to pay part or all of the premium, you can simply do that. And the policy
Mhm.
will remain in force. The dividend will pay the premium. They'll send you statements. Just make sure it's in good health. So that
Yeah, that's a great idea. Even if it cuts down on the payment a little bit, that helps.
yeah, and the fourth thing typically, and again, some policies have different things, but the fourth thing typically that you can do with that dividend is you can say, send me a check. So
Mhm.
if money's tight and your life insurance policy is generating a dividend, you could say, I want them to send me that $200 dividend every month or whatever it is. And your
Okay.
policy will stay in force and all of that. So the main point here is you can talk to your life insurance agent, or you can talk to us, of course, about these details. What really know what your life insurance is. Don't think of it just like, well, it's just death benefit, and when I die, my kids get it, and I got to make sure the beneficiary is up to date.
Mhm.
Really think about that. So, you can have, you can use this for several ways. One way to use it is to preserve your assets. Look, I have a lot of money, or I have a house, or I have this situation where I'm going to leave my kids or my heirs pretty well off. Well, you can just do that. You can just let them fight over the money when you're gone, and you can do it that
Mhm.
way. Or you could say, I want to put some life insurance on myself to free that money up for other uses.
Mhm.
So what they're going to get is my death benefit when I die. Now, this can become particularly important in certain scenarios. One would be you're a partner in a business, and
Mhm.
if you die, where is your partner? Can they, have they lost half the clients? Do they have double the expenses? Can they replace you? What is that like? And so oftentimes partners will buy life insurance on each other as key man policies or partnership policies to cover the other person. And that sometimes is just a term policy until retirement date, right? But
And those policies will pay out if you die. You don't have to wait like a will and probate, right?
that's right. They avoid probate. Boy, you're really learning this stuff, Jess.
I'm learning from you.
Yes, well, you're doing great. Yes, they avoid probate, so that money goes to your beneficiaries right away. Okay, so another place where this is really important, and I see this one often. Somebody's got a lot of real estate or even just one house, but they want to leave it to
Mhm.
their heirs, but they still have a mortgage on it. They still have taxes. They still have insurance. And
Yeah.
maybe their kids don't have the money to cover that. And it's
Mhm.
going to take 6 months, 8 months, a year to get through probate. What are you going to do
Right.
about it? Well, you know what? That life insurance or an annuity could fund that. It could give them the money they need right away to make repairs on the property, to pay the mortgage, to pay the taxes and insurance. So they aren't forced into a fire sale situation, particularly at a time when they're least well equipped to do it, when they're emotionally distraught over losing a loved one. So
Mhm.
there are, I think life insurance gets a bad rap. Even in my mind, I'm like, oh, I'm going to talk about life insurance. Somehow it's become and I'm going to lay the blame at agents' doorsteps here. Somehow it's become a tool to sell people stuff rather than
Yeah.
you should have in your portfolio.
Mhm.
And so the reason I'm giving this sort of broad overview today on life insurance, you notice I haven't even mentioned like burial costs or anything, right? Um,
Right.
is because I want people to think of it more broadly. So I promised to talk about how do you decide how much life insurance you need, because it's the number one question people ask. Well, how much do I need? I can
Right.
afford this much. How do I get that much on what I can? Whatever. Okay.
Mhm.
The way I recommend that you think about it is first you think about, okay, how much is it going to cost for my funeral? All right.
Mhm.
Then do I have any income I need to replace? Am I leaving a partner that can't pay the bills if my income isn't there? How do I
Mhm.
provide income for them and for how long? Maybe they're going to need 2 years to get on their feet. Maybe they're going to need 5 years. Maybe they need it forever, right?
Mhm.
Start to replace that income and you can back out your expenses. Geez, they won't have my car payment if I'm gone, right? And so you add that in. Then you start to think about education. What about getting my kids to college if I die prematurely, how do I fund that? Can I do it with life
Mhm.
insurance? And you start to add those things that are important to you. And at the end are things like, charity. I hate to say it's at the end because for some people it's at the beginning, but
Yeah.
you add in charity, you add in other kinds of expenses that you think you might want covered in your life insurance. And then anything over that is gravy. You get to the
Mhm.
point where you say, okay, I've identified a need, a phrase that salespeople love to use. I've identified a need for, $500,000 worth of coverage. But it turns out I can buy $1 million worth of coverage. And in fact, that's going to generate a tax-free income for me at retirement. So
Mhm.
I'm going to choose to do that. And then I'm going to borrow, 400,000 of that money or 500,000 of it. And I'm still going to leave the rest of it to my heirs. Right.
Yeah.
So it's really an important tool to think about, and I hope that people got enough from this show because it could be a 7-hour class and we would still never get through life insurance.
Yeah.
People got enough from this show to understand that this is in fact an important estate planning tool, not um, not something you get in the mail and go, oh, I checked the box, I got 25 grand, that'll pay to bury me. If that's
Mhm.
all you need, that's fine. But there are better ways to do it, I think. And having a real discussion with a pro who you don't feel is selling you a product or asking you, so how much can you afford, Jess? You know,
Right.
somebody who's really doing the work, who starts to talk to you about the kinds of things you've heard in this show, right? Somebody who's really doing that is worth having a solid discussion with about life insurance because it might be the way that you create generational wealth for your kids, that you protect them from the costs of probate and keep your properties safe, you protect your assets, and you may generate some wealth for yourself in the bargain and use it tax free. Yeah.
Yeah, that would be great. And I think that this is also a topic, like you said, there's so many different areas of it and questions and probably different ways that you can do things. I think that a financial advisor would be great for this, for help.
Yeah, for sure. And you just want to find one who is really asking you those questions about your life, not just numbers like, well, what's it cost you to live and what, yeah. You really
Yeah.
want somebody who will talk to you about you and try and find the right fit for you, not some cookie cutter plan. Yeah.
And I like the tip too about, when they ask you ahead of time what amount can you afford monthly, to kind of avoid that because you're right. You might say you can afford 50, but you don't need how much insurance that's going to buy. They're still going to sell you the $50 amount, the
Well,
highest amount that you want to do.
yeah, the biggest problem with that question is it is like a car salesman, and car salesmen get a bad rap too. There's some great ones out there, I'm sure, but it is like that. When you say 50, they know you mean 100. They're going to push you to 100, whatever, and
Yeah.
you know what they're going to do with it. That's why you gave them $50. But
Right.
what you can afford monthly has nothing to do with what you need. The
Hmm.
trick is to figure out what you need and then fit it into your budget using a variety of the techniques that are available under the different types of life insurances we talked about. You might end up with two separate policies or a blended policy to make it work. You
Okay.
might grow from one place to another and add on every year. I mean, there's so many things you could do, but it's important to get what you really need or want first and then make sure it's affordable for you by doing the other kinds of work that you do about budget and all that sort of stuff. Yep.
All right. Well, let's get your phone number in case anybody does have questions on this or
Sure.
any other financial matter.
Yes, absolutely. It's 413-773-3333.
And you can go to hugyourmoney.com. Thank you so much.
Thank you, Jess.
We'll be back again next week with another edition of Financial Fitness with the Money Doctor, Dr. Francis Ram, right here on WHMP.
Would you like to see your business on Financial Fitness with the Money Doctor? We offer a 15-year proven track record. We have limited openings, but are currently seeking sponsors and guests. Is your business a good fit? We'd like to start a conversation. Contact us today at 413-773-3333 or info@hugyourmoney.com.